Hello everybody, welcome to the channel where as always we provide you with education and information. Now in today's video we're going to talk about how you could still get life insurance even if you don't have good health. I know that's very difficult for some of you to believe, but that is a fact. You can actually still get life insurance even if you have bad health. So in order to understand this, the first thing you have to do is understand that there are 5 parts of a life insurance contract. So you have the insured, which is the person that the life insurance is going to be on. You have the insurer, which is the life insurance company, the company that's taking the risk to insure this person's life. You have the policy owner. You have the payer, and then you have the beneficiary. So this is the 5 parties that is involved in a life insurance contract. So the insured is a person that's life is going to be insured. The insurer is the insurance company, and the policy owner is the person that owns and controls the policy, and the payer is who pays the policy, and the beneficiary is who receives the death benefit. Now, the misconception that people often have is that these people have to be the same. The person that the insurance is on have to be the policy owner and the payer. These 3 people. Insured, policy owner, and payer. Doesn't have to be the same, right? It can be, but it doesn't have to be. So this is actually how you would be able to insure someone else's life, but you own the policy and you could still get benefit out of it. So I'll take an example. Let's just use a John. Let's say a guy's name is John. John is 45 years old. And he wants to get some life insurance because now he understands that life insurance gives you living benefits and you can use it as a wealth building vehicle. So now he understands. Now he wants to get a permanent life insurance policy. But John recently had some issues, health issues, maybe heart issues, whatever it is. And he doesn't qualify because it's very, very recent. Okay, and just as a side note, if you had health issues in the past, it doesn't necessarily mean you personally cannot get insured. A lot of times, if it's within a certain period of time, 2 years, 5 years, 10 years, whatever. But let's say it's recent. In this particular situation, it's recent. So John doesn't qualify to have his life insured. But John's wife, Karen, is in perfect health. Okay, Karen is in perfect health. Okay, she's very healthy. Karen is healthy, right? So what John is going to do instead is have the life insurance policy on Karen. So Karen will be the insured and he's the owner and payer of the policy. And by the way, payer doesn't necessarily have to be the owner as well, right? But in this case, payer's owner. So John's paying for the policy and he's the owner of the policy. Karen is going to be insured. Now, all John has to do to get insurance and Karen is have what's called insurable interest. What does that mean? Insurable interest. It means like it sounds. There has to be a reason why. John has to prove why he as a policy owner is interested in insuring Karen's life. It has to make sense, right? This is easy. Karen is his wife. So, of course, if Karen dies, it can affect John. So there's easy proof of insurable interest here. So as long as he can prove that, he can get a policy in Karen. So he's going to now open a policy in Karen. The policy comes through. John is the policy owner, which means that he has all rights to that policy. Okay? John could benefit from the policy. Guess who gets to borrow against the policy, even though they're not in good health? John, right? Guess who gets retirement income in their retirement years or whenever they want to pull out from the policy, John gets to do that. Guess who gets to change beneficiary if they wanted to and set it up? John gets to do. So he has all the rights as a policy owner, even though he's not healthy, and he's going to benefit from those living benefits from the policy, like borrowing against the policy for working capital, for education, for whatever reason. You can borrow against it for whatever you want, right? As a policy owner, you own and control the policy and can do whatever you want. So this is how John is going to be able to do that, right? And again, Karen is his wife, so that's easy to prove insurable interest there. So this is a way that anybody that still wants to take advantage of the benefits that comes with a permanent life insurance policy could take care of it by getting someone, and it doesn't have to be your wife, it could be your son, it could be your mother, it could be your brother, sister, anyone that you can prove that if they die, you can be affected by their death, okay? And that's how you prove insurable interest. And then you're going to be able to get all the living benefits of what a life insurance policy, a permanent life insurance policy, will provide for you as a policy owner, all right? So you're going to own, control, and pay for this policy, but the insured is the only person that has to be in good health, right? The insured. Now, this is exactly how banks and corporations are able to own insurance policies, because the policy owner and the payer doesn't have to be the same person. So they'll do what's called a key man insurance, and they will put insurance on a very important employee of the company, like the CEO, the CFO, any top executives. A corporation will put a policy on them, because should that person die, it will affect the running of that company, so that company is proving insurable interest there. So they'll have policies, what's called BOLI, which is bank owned life insurance, or COLI, corporation owned life insurance. These companies has a lot of money in life insurance, and the company is the owner, and the company gets the benefit, and the company is the payer of the policy, and the insured is just someone that works for the company. That's very important, and the company is easily able to prove insurable interest, because this is a high-ranking person in the company that, should that person die, like when Steve Jobs died, it affected Apple, right? I would guess that they had insurance on him, okay? Or whoever, any top executive. So again, just to recap, this is exactly how you can own a life insurance policy and take advantage of the living benefits, because you as the policy owner does not have to be the insured. The insured has to be the person that's healthy, and that could be anybody that you are able to prove insurable interest on, that should they die, that will affect you as an individual, or you as a company, or you as a bank. Okay, so I hope the information makes sense to you. I hope it actually helped you today. If it was valuable to you, I'll ask you to do me a favor and like the video, share it with someone that could use this information. Oftentimes people think that because they're not in good health, they just close the door and don't think that they could actually benefit from life insurance. Not true at all. So share this video with someone that could use the information. As always, if you haven't already done so, make sure you subscribe to the channel and hit the notification bell, so every time I make a video, you're the first to be notified. Until next time, see you guys soon.